There's a number of things that we have to do. And the first thing is don't procrastinate. Okay. This is post-tax season is the time when you need to take action. One thing that we often see are, and I hear this all the time, April's over. I don't want to talk about taxes until January.
Now, do you think that's because people got a bigger tax bill than they expected? So it's one of those, I know I cut myself, but I don't want to look at it?
Well, that's part of it.
Or I didn't have as big a bill.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement.
Hello and welcome. My name is Matt Landon. This is the Semmax Way, and I'm joined by Mr. Jordan Shinsky. Today, we're going to be talking about everyone's probably least favorite thing to go through, but most important, which is taxes. Now, when we think about taxes right off the bat, I want you to tell me kind of right away, what are the steps now that tax season is over? What do we do? What should we think about?
Well, there's a number of things that we have to do. And the first thing is don't procrastinate. Okay. This is post-tax season is the time when you need to take action. One thing that we often see are, and I hear this all the time, April's over. I don't want to talk about taxes until January.
Now, do you think that's because people got a bigger tax bill than they expected? So it's one of those, I know I cut myself, but I don't want to look at it?
Well, that's part of it.
Or I didn't have as big a bill as I thought, so I don't have to worry about it.
That both of them, there is this general negative connotation around the idea of filing taxes, right? There's a lot of headache to it. There's a lot of, did I do it right? That whether I get a return or whether I get a refund or I'm paying taxes, that I don't want to deal with the stress and the headache until next year. Not the right thing to do.
Well, and I think it's important also to keep in mind, there's a difference between tax preparation, which is just you collect all the statements, you throw it into the program, it says what you owe or what you're getting back, and tax planning. And I would argue tax planning is an ongoing process.
It is. And that also helps reduce the stress of things. Right. So people who are oftentimes stressed around the idea of tax planning, a lot of it's because you're just unprepared. When you have proper tax planning in place, that you're executing a plan that has been implemented not just for this year, but when we're looking at the long term, the big picture of tax planning, it helps people kind of settle into it. You have a better understanding of what you're going to face as you're entering that higher stress period in time, and it helps people kind of approach it from a different perspective, a different mindset.
I know something that we do here is we give people a tax report. And so you bring in your tax return from last year and we run a whole tax report and then we'll use that. We'll do planning and things. But one of the things that I find is most helpful is actually just showing people this is what you paid, your total bill, not just what you paid from a check standpoint.
Oh, yeah.
Would you argue there's a couple key things that people miss or misunderstand around their tax return?
So that's a huge misconception, is that oftentimes when you file your return and you see, I got to write a check for $8,000 or I get a return for $2,000, that's their tax bill, right? That's their results from their tax season. That's not the case at all. In most cases, people are paying taxes throughout the year.
You're having whether it's withheld from your paycheck.
That's right.
You're withholding from your IRA
distributions, right?
Okay.
So oftentimes when someone says, oh, I owed $8,000 in taxes this year, I didn't expect that. They may be looking at a total tax bill that might be $20,000, $30,000, and that's just the shortfall of what they owed as the remainder. In the same way, if I get a tax refund of $2,000, someone may look and go, I had a great tax season. I got $2,000 back. You may have still owed or paid throughout the year $12,000, $15,000, $18,000, but you just paid too much and they gave you some of it back.
Beyond that, you just gave the government a interest-free loan.
Exactly.
For the full year of that $2,000.
Now that part of the emotional response or the connectivity to a refund or paying that's a whole nother conversation, because a lot of times people look at that and say, I look forward to a refund knowing that, I give the government money ahead of time and they use it to their advantage, but maybe I use that to pay my property tax every year. Maybe I use that to fund my vacation in the summer. So oftentimes the comfort for people of getting a refund is more beneficial for them than the stress of knowing they're going to have to pay.
And I think as long as it's kind of within a window, that's okay.
Yeah.
If you're getting a small refund, you're owing a little bit, that's a little different than cutting that $8,000 check like you referenced earlier. But I think on the diagnosis side, understanding, well, why did I have this bill? kind of thinking through that and saying, all right, was this from capital gains? And were those capital gains from stocks that had a big gain and I sold them because market was kind of turning? It was like, this is the time to close it out. Or
Right.
I had a big purchase and I needed to do that. Versus, wait a minute, I had all these capital gains and I don't remember selling anything.
Yeah.
You got all these mutual funds in your account. Would you say there's certain areas, in your opinion, that are kind of key to focus in when you're trying to diagnose what was my tax burden like last year?
Yeah.
And kind of understanding that triage side of things.
Right. So step one in working through the process of how do I take corrective action? How do I respond to my taxes from last year? The first step is to reevaluate your return. And don't just look at it from the number perspective. I owed $8,000. I got $2,000 back.
So that final number is not the only number that matters.
It's not the only number,
Right.
okay? The why behind it is what is key, okay? Looking at the income that I got, where did it come from? How was it taxed? Did I have withholdings associated with it, right? That all helps understand the basis of what created that bill or that refund, okay? So you have to dig into the why behind it, not just looking at the number. The number is only going to generate an emotional response. Having the ability to generate a strategy is looking at it through analysis, and the why is what's the most important in that first step.
So then once you've got that kind of why understood, okay, we figured out why we either got this big refund or why we owed, kind of what's factoring into that. What would you say the next step to move forward is based on what that diagnosis tells us?
Coordinating with our professionals. And this is where actually step 1 and 2 kind of work hand in hand. Okay. Yes. Can you go ahead and evaluate your return yourself?
Yeah.
Sure. Okay. Is there a chance that you're going to miss something or you're going to misinterpret something? Yeah. Work with your professionals. And by that, I mean, within our lifespan, we typically work with the trifecta of 3 professional services. We're going to work with our financial professionals, your CFP for your finance side. You're going to work with your CPA for your tax side, the tax planning, the tax preparation, the tax reporting. You're going to work with an estate attorney. So the legal side of your professional life, you're going to want to work with. And oftentimes, all 3 of those professional services work hand in hand. Making a decision from one aspect could and more than likely will impact those other 2 services, right?
Right. But I would also say on the tax planning side, I find more often than not, when you talk about tax planning with a CPA, they're thinking about the safe harbor, right?
Mm-hmm.
And for those that don't know, the safe harbor is the minimum amount that you need to have withheld so that way you don't run into underpayment penalties, because it's amazing. If you owe too much at the end of the year, they charge you extra.
Right.
So it's like, you want to make sure you don't run into that safe harbor issue. But beyond that, a lot of CPAs will say, well, we just need to do quarterly estimates.
Yeah.
We need to do quarterly estimated payments, make sure you don't have any issues or up your withholding. And that's the tax planning. And I think that's very different from what we do. And that's where, when you think about next year's taxes, there's things we can do today that are either going to make it more expensive or less expensive. If you're in your retirement years and your charitable giving, things like QCDs, those qualified charitable distributions, you should not be gifting to a charity from your checking account. It should be coming from that IRA account. We don't want to be paying taxes on that. You can enhance what you're getting.
But more importantly, there's also a time and a place for a particular type of person that can utilize that type of distribution. So talking with your CFP is making sure that you're having all those basis points covered to make sure that, yes, you're doing it, but you're doing it the right way.
Yeah. And I think that's where you want to look at it holistically. Mm-hmm. So you can't just think about your finances and say, this is how my account is invested. That's one thing. Mm-hmm. This is how my tax return is. That's a totally separate thing, because they're intrinsically intertwined.
Oh, they are.
Right?
They are.
When you notice this, when you step forward into it, I would argue one of the places to start is with the end in mind. It's like, where are we trying to get 5 years from now, 10 years from now, 15 years from now? Because that could occasionally mean a slightly higher tax bill next year to reduce your ultimate taxes.
Well, that's one of the steps in the process, is having a forward-thinking approach. Yep. There is a huge difference, and this is not just about tax planning, but this is about your finances and everything, your wealth transfer strategies, being proactive and forward-thinking instead of reactive in what you're seeing in that evaluation is key. And I'll use a quick example, okay? If you look at a situation where last year I had an unexpected tax return that I had to pay a lot more in taxes.
Okay.
Well, an example, I'm 75 years old. Me and my wife are retired. We have about $120,000 in income. Our income sources, 2 sources of Social Security, 2 annuities that are qualified, Okay. And then whatever shortfall I'm distributing out of my IRA.
So what you're saying is when a qualified annuity, that means it's from an IRA.
Correct.
Right?
Correct.
So non-qualified is that term that people will use. That means it's not qualified for tax deferred status,
Right.
which is a mouthful that just means you've already paid taxes on it. So you only pay taxes on what you make.
That IRA money, you haven't. So anything that comes out of it within a given tax year is taxed at whatever standard income tax rates you're exposed to in that year. Well, let's say I have a one-time expense. Our vehicles are old. Both of us need to go purchase new cars. We take out $50,000 each from our IRAs. Again, not taxed money, right? Until it's distributed. So in that 1 year, I now have $100,000 in additional income that I'm reporting that maybe I didn't have any withholdings, thinking all I have to do is take this money out and go buy my car with it. Now tax season comes around and I file and I go, why do I owe all this money, right? A reactive plan would say, simply put, let's go ahead and increase our withholding on our income. Maybe I increase the withholding on my Social Security. I call the insurance company, hey, I need more withholdings for my annuity. But looking at the evaluation of why that increase in income occurred, it was a one-time expense. So do I simply make a change being reactive to last year's plan? Or do I look at it and say a proactive plan tells me this is a one-time expense. If I have to buy a vehicle again, okay, I now have a strategy that I can employ in the year that I'm making that capital expense. But if I make the change simply being reactive of last year's return, I'm going to put myself in the opposite direction that is still not going to be the right approach.
Right.
So that's being proactive.
Even with the example that you gave, part of your Social Security is going to be taxed, or none of your Social Security is going to be taxed.
Right.
Or more of your Social Security is going to be taxed, depending on what your other income is.
Right.
So that's where understanding that distribution to say, okay, maybe I'm better off splitting that distribution into 2 years.
Yeah.
Taking out a small loan on a piece of that car just for a couple of months, paying it off, because that can keep not only you in a lower tax bracket on that IRA distribution, but it can also mean you're staying where you're paying less taxes on your Social Security,
right.
And that can flow forward.
Well,
Keeping
and that's
in mind also your Medicare premiums, which show up, what, 2 years later?
Yeah.
So that's the kind of example of, I would say, that forward thinking is, before you talk to your advisor or just say, hey, I need to withdraw $30,000, and go, hey, I think I need $30,000 because I want to accomplish this.
Yeah.
Is the best way to do it take a lump sum? Is the best way to do it try and spread out? What are my options available? Obviously, I know you're not a big fan of debt. I'm not either.
Right.
But I think appropriately leveraging things, it can come out to your advantage at certain times. Well,
and that's where having the conversation with your professionals, sitting down with your CFP and looking at this is so key. What are the options available to me if I run into this again? Well, maybe my wife and I don't buy a car in the same year. Maybe I buy one in year 4 and she buys one in year 5, right? Maybe we just increase our withholdings. Maybe we have non-qualified, that brokered money. Maybe we have Roth money that we take that doesn't have tax consequence on the distribution, right? How does that impact those other professional services? Well, I'll use this as an example. Maybe instead of the next time I buy a car, I don't take from my traditional IRA that increases my taxes. Maybe I draw from my Roth. But my Roth money I had positioned as a wealth transfer strategy. Now, if I'm using that money in my lifespan and instead of the initial impact of transferring it to my heirs, well, what does that do to my estate strategy, right? Yeah. So now I have to have a conversation around my legal planning, okay, around my wealth transfer, because that may affect things. So being able to sit down and look at it with the big, having someone that can identify the big picture from a holistic approach is what is key in this decision making, because one particular strategy may impact other aspects that all have to.
And I think you raise a really interesting point there, particularly on the Roth side, because oftentimes the concept behind the Roth is don't touch it.
Right. Or wait as long as possible.
Other people say, well, I'm going to use all of it now because then my tax bill is low as possible. There's kind of a middle ground that says this is a money type. It is a tool. And there are times where you're going to use it and there's times where you're not.
Sure.
So I think, you do woodworking, right?
Yep.
Would you argue you use every saw the same amount?
No.
What's your default? What do you go to? Miter saw, circular saw, table saw? What are we talking?
My table saw is probably mostly used. That's what I use more than anything else. Yeah.
You cannot use a table saw for the things you need a jigsaw for.
No,
right?
You can't. You have to use the right tool.
theoretically, you could use a jigsaw to cut boards and rip them and everything else, but you're like, this would be horribly inefficient.
Right.
You know, so it's like you could use that, but it's not the right tool for the job.
That's it.
You know?
Yep.
And I think the same thing applies with finances. It's much easier to look at a table saw and go, well, obviously I can't do scroll work with that. But when it comes to our accounts, when there's a lack of understanding, and the key thing here is it's not your fault, right?
Yeah.
It's like with woodworking, if somebody showed you how to do some of this stuff.
Sure.
Right? It was like, now you continue to learn and you develop. And once you know what questions to ask, that can help you go forward with it. But when you first started, who sat alongside of you and said, this is how you rip a board, or this is how you do different things? Like, was that your dad? Was it somebody else?
My dad, people that I know that have been in the industry, you can do it as an apprenticeship. Nowadays, you can use YouTube to learn new stuff that you didn't understand prior to, but someone's going to teach you a lot of this stuff. Well, our tax preparation, our financial planning, that's kind of the same way. You're going to have someone who's going to teach you. Maybe my grandfather taught me about stocks 50 years ago, or taught me about how do I file my taxes 50 years ago. Well, let me ask you this. How much has changed in the last 50 years? How much has changed in the last 5 years?
Glad you went there, because that's where I was headed, was to say that, structural integrity of wood is structural integrity of wood.
Yeah.
That really hasn't changed over the last 300 years, Now you look at it and you go, that's not real wood. But aside from that, it's like a piece of furniture is a piece of furniture.
Yeah.
Now you look at what's going on with the tax code today, it's wildly different than it was 50 years ago. Which is radically different than it was 150 years ago.
Yeah.
And at this point, I mean, you have thousands upon thousands of pages in the tax code. And I would argue the people that wrote it don't even know what's in it.
Most of the time, no.
So then you've got guidance and you're trying to get clarification of how does this kind of stuff work. And I think it's to the point where I think it's important for folks to know the basics of what's in your tax return and how things impact it. But I also think, unfortunately, it has gotten so convoluted, you almost need a professional or a second set of eyes, or you will miss things.
Right.
It's like
I agree.
Little things where you go, well, if I'd known that, obviously I would have done it. And you're like, yeah, but you didn't know it, but it's really not your fault. It's gotten so convoluted, and things like when to itemize versus to do the standard deduction and ways to maximize those. There's a ton of deductions available.
Yeah.
There's a ton of ways to enhance that, and not just deductions, not just tax credits, but just strategies to keep that bill down. But the thing is, if you were to try and list them out, I mean, you could talk about QCDs, you could talk about our advice funds, you could talk about CRATs, you could talk about CRUs, you could do about exchanges, multiple types of exchanges. Exchanges from insurance products and insurance products, exchanges from property into property. There's a lot of different ways you could do things. DSTs, I could ramble about this for all day.
Oh, yeah.
But at the end of the day, what would you say the one thing that people need to look at if everything else they were going to look at and say, what's the one step I should take?
Consulting your professional. That's the easiest way to put it. Two things. Being proactive. Like I said, we talked at the very beginning. Don't wait until January to make these decisions. Okay. Strategic things that need to be implemented now, or have to be effectively implemented throughout the course of the year. You mentioned a lot of these strategies, right? Using things like charitable giving, using stuff like Roth conversions. There are oftentimes default that we may say, hey, we'll talk about Roth conversions at the end of the year. But if we have a 10% correction in June, and the markets are down, maybe we have an opportunity to execute that Roth conversion ahead of time. So being adaptable within your plan is important. Having that plan in place now rather than waiting is important, and consulting with your professional to make sure that you have that plan in place and that all three of those aspects of those professional services have been discussed to make sure that it's all cohesive.
So let me ask you this then. When you think about the different steps you can take, and how it can affect spending, what you can spend at the end of the day. We have a lot of clients that have sizable IRA accounts.
Yeah, yeah.
And sometimes the only thing they're thinking about is taxes.
Right.
And they know full well, if I pull from this, it's taxed.
Yep.
What do you say to that person? Somebody that's got $4 million in an IRA and they go, yeah, we'd love to take that trip, but if we pay for it, we're going to have to pay taxes. So we'll just, What do you say to somebody in that kind of situation?
Taking a look at the big picture of things, if someone's going to have that trip that they're taking this year and it's a one-off, well, maybe we do stuff like find other ways to have a deduction. Do you have property? right? Do you have somewhere that you can offset that income with a loss? Maybe we do additional charitable giving. Maybe we utilize a donor advised fund and move assets into it that we can then reduce that consequence that, so to speak, will offset that additional expense and tax consequence to you.
Right.
There's strategies that we can utilize. We really have to take everything one step at a time with the client and the opportunities that we can present, because everyone's situation is unique. I cannot say this enough. Tax planning, financial planning, those aspects, there is no cookie cutter approach to fixing someone's problem, to implementing a solution, okay? You have to look at every occurrence and evaluate what is going to be utilized, what is going to be beneficial or detrimental to that situation at hand.
Well, I know we've talked about this before, but I sort of think whether we're talking about financial planning or tax planning or anything along those lines, you can almost think about it like a giant board, and you have 80 different things on the board. And as you talk to somebody, you go, okay, that one doesn't work. That one doesn't work.
Yep.
That one doesn't work. Okay, this, in your situation, you ask them clarifying questions. Nope, that one's off the board. And then by the end of that conversation, you're left with, hey, there's still 7 strategies here we can employ.
Yeah.
Let's talk through those and look at the pros and cons and what makes sense and how to move forward.
Yeah,
right?
That's it.
Yeah, because I think about this a lot. It's like when we talk taxes, nobody really likes paying tax.
No.
At the same time, and I believe this very strongly, there's a certain amount where it's like, we should pay our taxes. We should pay what we owe. You know, it's a biblical precedent. Render unto Caesar what is Caesar. So there's an aspect of this where it's like, we're all part of a functioning society. I know you've got 2 wonderful kids. I am okay with paying taxes to help support the teachers that are educating your children. God hasn't blessed us with kids, but I am okay with paying those taxes. It's like, you're welcome.
Thank you.
But here's the thing. I'm not okay with people paying taxes they don't have to.
Yeah.
You know, it's like, pay what you owe. Let's be responsible. But if you can reduce that tax bill and either give more towards charity.
Yeah.
You know, it's like, okay, there's a certain amount you're not going to keep.
Right.
We can either give this to kingdom building or we can give it to Uncle Sam.
Yeah.
You know, it's like, there's a certain amount you're not going to keep. My wife and I, we foster golden retrievers. We've had multiple of them. It's like, okay, you can give it to the black hole that is Washington, D.C., or we can give it to this rescue foundation, and you can see this golden retriever running around. It's like, I feel like those dollars are better spent here.
Yeah.
Right? But
More valuable. Mm-hmm.
You know, it's like, there's a certain amount we owe. Let's pay it. But there's a certain amount we don't have to pay.
Correct.
And I think there are people that are paying unnecessary taxes because they're not paying attention to it. And I think part of the reason they're not paying attention to it is something that you said earlier. You're 3 different professionals, right? You want your tax professional, you want your CFP, your financial professional, and then you want your estate professional. You want the guy putting together your estate documents. Well, when you talk to your estate attorney and they say, hey, do you want to give money to charity? And you go, yeah, sure. And they write it into the will. That's coming out of funds that are going to have a step up in cost base.
Right.
They're not talking to you about taxes, because if you say, well, what's the tax consequence here? They're going to go talk to your CPA. Then you go, okay, so let's not finish that will. I'm going to go run and you talk to your CPA, and your CPA goes, I'm not talking to you about your will. Talk to your attorney about that. I'm talking to you about taxes. You know, it's like, it gets a step up in basis, you know, have a nice day. And then you go back and you go, I guess let's do it this way. And that's where I think the CFP kind of sits in between and looks at all of it, because we're not just looking at your IRA account and your non-qualified account. We're looking at your total estate and looking at everything and saying, hey, when you're talking to that executor, well, why are you wanting to leave money to charity? Well, I want to leave 10% to the church. Yeah. Right. Okay, great. Is there a way that we can do that out of funds that your kids would have had to pay taxes on? Right. As opposed to funds they wouldn't have had to pay taxes. You know, those kinds of strategies, there's a lot of things you can do that are beyond just fill out the document, get it done.
The CFP, your CFP is going to be your event coordinator. Okay, your wedding planner, right? I mean, it's the person who's going to bring everything together. Yeah. You know, working with just a financial planner and who's going to focus on just your finances is no different than the way the CPA is only going to work with your taxes, and the estate attorney is only going to work with your will, your estate plan, maybe that trust that you're implementing, right? Having a CFP that is going to be a fiduciary that is looking at things holistic across the board has to have the conversation around all 3 of those and the way they're impacted. Now, as a CFP, I'm not a licensed attorney. I'm not a licensed CPA. However, having that conversation and knowing the necessity to coordinate all 3 of us together is key.
Yeah. And I think when you pull it together, you're able to take that holistic approach and you can put together a team. That's why our office has been offering tax services for years. We've been offering legal services for years. It's like, no, Jordan, you're not going to do the tax preparation.
Right.
You're not going to do that will, but you're involved in that process to make sure that ultimately folks' wishes are what's accomplished.
Yeah.
And I think that's the key thing. When we talk about taxes, it can be really overwhelming and it can be confusing, and it's easy to look at and go, stop, you're scaring me. I'm confused. I don't want to do this. I'll deal with this next year when I have to. But sitting down and having it make sense and understanding, why does this happen? You know, because I think that's the key thing. Understanding, why do we have RMDs?
Yeah.
How did my Social Security end up getting taxed? Why did it get taxed this way? And then you see the interplay between the two and you go, wait a minute, they said we can tax your Social Security. And then they immediately put in RMDs and they go, now you have to take money out. And you go, oh, now my income's high enough. We can tax your Social Security. That didn't happen on accident. Right. And I think when we look at things from a historical perspective and understand how did we get where we are, it can give you a little bit of insight into where we're headed. Right now, history is, those that don't learn from history are doomed to repeat it.
That's it.
That doesn't mean prior experience is automatically going to move forward to be the exact same. You see that with the stock market all the time. It's like, oh, the stock only went up. Doesn't mean it's only going to. Things do change. But when you have an understanding of the why, that really helps.
Well, I use the example. Last year was a big year, right?
It was.
They passed that big, beautiful bill, had changes to the standard deduction, the addition with the Social Security changes and things of that nature. You're talking, there's income limits associated with it. There's age brackets associated with it. Looking at that and making sure that we're reevaluating whether there is an opportunity for me to take advantage of it, or if I'm not quite there yet, or do I need to make a change to be accessible to it?
Because a lot of people make changes with their tax planning based off of the Secure Act and the But now with the big, beautiful bill, you've got the changes with state and local income tax deduction and SALT. So you got to keep all this kind of stuff in mind and continue to refresh along the way. So I would just say this, if this is something that's been interesting to you, I hope you enjoy it. I hope you made it this far with this. But if you'd like to explore it further, we've got a ton of resources. I would point you to some of the specific videos and podcasts we've done on different nuances around just RMDs and Roth conversions and other things. And I would say listen to all of it, learn, educate yourself. And if you'd like to have a conversation, you always can.
Absolutely.
But Jordan, thank you so much for taking time out of your day to join me.
You got it, man.
I always love it when we're able to sit down and do this kind of thing. So on behalf of Jordan, myself, and the whole team here at Semmax, thanks for listening, and I hope you have a wonderful day.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended to consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.